Try to stay in 25 minutes. Try to start. That you have some time, some flexibility.
Okay, so good morning, everyone. Hannah and are going to present this paper that we have been working on with other colleagues. So it's Etienne, Antoine, and Devin. And as you can read from the title, it's about bridging the climate gap and using the stock-flow consistent approach to study climate finance questions, which is quite interesting because, as you know, SFC models address in detail the financial side. So if we have a question about the financial topic, then this approach should be suitable. So the motivation for what we are doing, as you know, in order to undertake this low carbon transition, we need financing. These are some of the most latest estimates on how much needs to kind of financing to be raised in order to cover all the investments in developing and emerging economies. The questions that one could ask related to climate finance is what are the impacts of the different financing strategies, because finance can take different forms and this is not neutral. So SFT models can be useful to address the differential impacts of the different financing instruments that we use to finance a low carbon transition. What are the constraints on climate finance? So if there is a climate finance gap, what is explaining this gap? And what can be done in order to reduce this climate finance gap and facilitate the low carbon transition? So what this paper is to use the framework of an empirical stock-flow consistent model, in this case for Georgia, not the state in the US, but the country. You may ask, why Georgia? Well, because it was done in the context of our work at the World Bank, and we were mandated to build a model for Georgia to address these questions. So that's the reason why we chose this country. So it's an empirical SFC model for Georgia, but everything I'm going to present now about the theoretical proposal on how to model credit rationing and the climate finance gap is a theoretical proposal, because as you will see from the equations that I will show, most of the variables that we are operationalizing here, there is no data for that. At least not in the national accounts. There may be data in some financial sources like Bloomberg and so on. We don't have access to that. So this is a hybrid exercise because the macroeconomic structure is fully empirical, but the climate finance block that we are going to present today is theoretical. So in a nutshell, this is the mechanism that we want to capture or represent. So in order to close the low carbon transition problem, or to finance all these investments, we need some desired reinvestment. So this is somehow estimated by whoever that knows how much money needs to be invested in order for the productive structure of a country to be transformed and made sustainable. But as you know, investment is not the same as finance. You may have some number of desired investment, but that doesn't mean that you will get the financing. So we have this distinction over here, but the desired investment of the financing needs lead to some demand for finance. But if there is credit rationing, then not necessarily all the desired investment and finance will be effectively financed. So as a result of the credit rationing problem, there will be an effective climate finance flow that will lead to an effective reinvestment that in turn will have different impacts at the macro level, impacts on GDP, the trade balance, the balance sheets, and many things that you already know because they are embedded in the SFC strategy. Now, as a result of these differential macroeconomic outcomes, then we have impacts on macroeconomic stability and, of course, on greenhouse gas emission reduction. But, and this is the novel feature that we are trying to incorporate in the model, there is a feedback effect from the different macro financial indicators into the risk measures that agencies build when they decide or they rate the different countries. And credit rationing is, in turn, a function of these risks. Just as Yanis and Adam, for instance, were doing in their paper yesterday, where they have credit rationing as a function of the major risk, we do the same. So here we have this loop that this is what we want to operationalize or explain. Basically, the idea that there is an endogenous credit rationing driven by risks that are endogenous too. And the second feature that we will try to operationalize is that instead of having just risk as an abstract measure, we will have several measures of risk based on the literature on risks related to the low carbon concept. So this is in a nutshell the mechanism that we are trying to define. So what are the risks that people like, for instance, Nadia and Nelly have been identifying as elements that are blocking the low carbon transition? We have the sovereign risk or the country risk. We have risks more associated to the sector where these investments will have to happen. We have the project risk, so a very micro-specific type of risk. We have the credit risk. We have the political risk. A bunch of risks that people that when people that have to make the investment decision and the financing decision look into before deciding where to place their fund. I don't know, in solar energy production in Brazil, in Morocco, or in Europe. Okay. As a result of this combination of risks, what we may get is the climate finance gap, so the situation where investment needs exceed the available finance. And there can also be, let's say, self-constraint by investors when the cost of financing or the cost of capital gets too high. So if in a certain country the risks are too high, then the cost of capital will be high too. And at some point, the investor, not the financier, the investor will decide or may decide to invest less than what is needed to close the low carbon transition gap, because the cost of capital of those investments is so high that the investment is not viable. So in that case, there is no climate finance gap, but there is an ambition gap or whatever you want to call it, which is not a constraint imposed by the financial sector, but a constraint imposed by the investor itself, or himself or whoever, because of the high cost of capital generated by the combination of risks. So the challenge here is to design policy mixes that can expand the investable space, focusing both on the demand side and the supply side of climate finance. So what we design or try to operationalize in the model is basically this market for climate finance, where we have green finance demand, let's say, that it is exogenous for us how much needs to be invested in each country in order to reach net zero by 2050. So this is information that we take, for instance, from the CCBR or any source that we want to use. This defines a total desired green finance demand that is affected by the interest rate, as I was saying. So if the interest rates of different financing instruments is too high, then the demand for climate finance will be lower, because people will, or investors will no longer be willing to invest, because again, the viability, the financial viability of those investments would be harmed by the high cost of capital. In turn, the different types of interest rates that each kind of finance instrument has defines the financing mix. So how much do I want to raise in green bonds in foreign currency, or in green bonds in domestic currency, green loans, or in whatever financing instrument I want to use? There is a portfolio decision that is made by the investor depending on how cheap or cost or expensive each of the financing instruments is. So here we have like the demand side for climate finance that is driven by the price or the interest rate of each financing instrument. But of course, the price of the interest rate is also driven by the supply. And the supply is, in our framework, a function of the macro risks. So if the financial markets identify that a given country, Georgia in this case, is subject to very high risks, then rationing will be high, supply will go down, and the interest rate will go up, thereby affecting, again, the demand side. So this is a classic, I would say, market mechanism that we are trying to embed in the structure of an SFC model. What is novel in this case, I think, is that maybe it's not so normal to find in SFC models such detailed description of the different market forces that are playing out in a specific market, in this case, the climate finance. So let me see how, okay, 5 minutes, no, 12.5, I said, okay? Well, 3 minutes I have for the equation, so very quickly, I mean, the system of equations aims to represent what I had in the previous slide. So this idea that we have supply and demand and different mechanisms that are interacting simultaneously. So here what we have is the price equation or the interest rate equation. It is a differential equation that depends on the excess demand. So if these are demand for a specific financing instrument, it's supplied, then the interest rate will go at a speed beta. So this beta implies that there is a speed of adjustment. Not all the market disequilibrium is closed in a given period. It's a partial adjustment function, let's say. Next slide. Now, on the demand side, as I was saying, what we have is that the investor will define its financing needs based not only on the target, so the maximum amount of investment, which is defined by how much it needs to be invested in order to reach net zero, but this may be lowered by this eta parameter, which is a function of the cost of capital over here. Here, what I have in the functions, the main argument is the average of all the different interest rates that the investor may pay. So the higher the cost of capital, the lower the desired financing needs of the investor, because again, the investment may be not viable. So this defines a bit the ambition gap that I was saying before, the idea that investors may be willing to invest less than what they need to reach net zero just because the cost of capital is high. Now, the total demand in the interest rate equation that I showed before is determined by, in turn, it's a stock that we have in the excess demand function. So the stock of, in this case, let's say, the financing instrument that I am representing is green bonds in foreign currency. So I define at every point of time the desired demand of green bonds in foreign currency as the starting stock plus a change. We have the dot. And this change is in turn determined by this gamma parameter that is coming from this arbitrage situation or process that in turn depends on the relative prices of the different financing. So the cheaper a financing instrument gets, then the higher this gamma becomes, implying that the investor is willing to finance a larger share of its investments in this financing instrument because it has become relatively cheaper. On the supply side of my excess demand equation determining the cost of capital, what I have is, for instance, if we are talking about green bonds in foreign exchange, we have that the cross-border lending, so the supply of these green bonds in foreign exchange is given by several factors. Many of them are exogenous because they are determined outside the country, but the key questions here are the last two terms, where we have first the relative return of the green bonds that the investor is financing here. So the higher the interest rate on green bonds, the higher the willingness of the rest of the world to purchase these bonds because they will become more profitable. So this will drive supply upwards. But then we have that the supply of climate finance green bonds, in this case, may be lowered by this rationing component. And this rationing is what we try to model endogenously to explain what their drivers are. So following the literature on this topic, mainly Nadia and Ellie's work, what we identify is different sources of risk. As I was saying before, the sources of risk that have been found relevant to explain credit rationing on the climate finance side. So we have these sigmoid functions where the different sources of risk, I will just show the first one as an example. For instance, the sovereign risk is bounded between a lower and an upper bound, and it's mainly driven by this Z parameter, which is given by the debt to GDP ratio. So the idea here is that rating agencies lower the rating of each country regarding the sovereign risk whenever the debt to GDP ratio increases. So if the ratio increases, then the risk will go up. That's why I have a minus sign here. And thereby the risk or the perceived risk for the country will be high. And the same we do for the rest of the risk equations. Again, I'm not going to show one by one because I don't have time, but we have the private sector risk, we have the exchange rate risk, the business cycle risk, and the interest rate risk. So we have 5 different sources of risk determining the credit rationing, as we see in the next slide. Basically, how do we determine the rationing? We multiply or we combine all these sources of risk, and we transform this. I mean, we use this tan H function to ensure that the rationing parameter is bounded between 0 and 1, and the main argument of this rationing that defines supply is given by the risk embedded in the financing instrument that we are measuring. So in a nutshell, what we have is the supply and the demand for the different type of finance instruments, and the combination of the supply and the demand, of course, drives the price, the interest rate of the financing instrument in this case, which in turn determines both the ambition gap and the climate finance. So this is the theoretical proposal. Now Hannah will take over and show how the results look. Well, I have one more slide. Well, this I mean, this is the final climate finance. Yeah, well, this is the how much finance is provided. Well, we have this if-else function where if supply is larger than demand, then the market closes by, I mean, the supply constraint. If demand is larger than supply, then the final climate finance flow is given by. This is what this equation was saying. So now, yeah.
Let's check. You want to?
No. Or I can say it.
Yeah, I thought.
Okay, well, I mean, why use SFC models for this? I don't think I need to explain this to you, so I can skip this. The key features of the model, this is, as I was saying, an empirically calibrated model for the target economy for this time range. So we don't need observation. We are using econometrics, so this is the reason why using the CNA optimization method to calibrate the parameter of the models can be done, but I'm not happy having so few observations for this, but it's still possible, and the performance of the model is quite good, but still I think that, yeah, it would be better to use quarterly frequency or, yeah, more observations to calibrate the model. Well, we have the agents in the national accounts, the sectors of the national accounts. So here there is nothing new to say. The key contribution is, as I was saying before, endogenizing risk, interest rates, and credit rationing. And of course, as you know this, but in other contexts, it is important to make this distinction that in an SFC model, typically investment is not the same as saving, and in turn, saving is different from finance. So this is a distinction that needs to be kept in mind.
All right. So Sebastian just explained to you our proposal to endogenize different sources of risk and the resulting perceived risk and rationing. So then what we do now is we take this climate finance module and we plug it into our SFC model for Georgia. We show you first a baseline scenario, how this module plays out. And then we take different scenarios and also sensitivity analysis to show you a bit the main relations and that we try to capture. And so we start by looking at these different sources of macro risk. We have 5 in total that are endogenous in this model. And I'm showing you here our whole timeline. So our in-sample period that starts from 2010 goes to 23, and our sample period 30. And on top we have the 5 risks, and at the bottom we have what we say is that the main driver of this risk, so what we call the zeta variance. So it's pretty easy to spot here from the sovereign risk where the main driver is public debt. So you see quite clearly this relationship. So we have these functional forms that bound our risk so that we can interpret it as a percentage point for this risk. And so we have those 5, and same with sovereign private sector, society, and interest risk. And if you take those 5, what we're getting is we have perceived risks for our individual green financing instruments in the model. And we have 7 of those, but I'm not going to show you 7, but we just have an example of 2 here. So the third row is all about green loans in domestic currency, and then the bottom one are green bonds in foreign denominated currency. And so what you see here is in levels, the perceived risk look very different. That is just because of our parameter choice here, which is pretty basic, but it's a bit higher here for the green ones because they're also subject to currency risks. And we have now this relation between this perceived risk and rationing. And this rationing then also defines the total supply. What we have in the middle here is this interest rate of all of these financing instruments, which is a function of the excess demand. For example, the green loans, so we see that it's going down because we have an excess supply in this case right now. And this lowering interest rate at the end shows you also how the portfolio share of green loans across all of the instruments we have is going up. It usually goes in the opposite direction, interest rate and portfolio share, but of course it's the relative cost that matters for the direction. Right, and then if we have everything on the level of the instruments, we can also see what is happening at the total investment demand and realized one. So we have data, for example, for Georgia, for the investment needs or financing needs. So we on the net zero path, so that would be our black line here. And then we have these desired financing needs and the realized one. And as Sebastian explained before, the difference between the black and the blue line is our ambition gap, and that we're plotting in the middle here. And the difference between the blue and red line is our climate finance gap. And this, especially the ambition gap is a product of the average financing costs, which is on the right here. Right, and since this proposal is still a theoretical one and we're still not using data to validate the functional forms of the parameter values, as a first step, what we could do was use different scenarios to understand a bit more what is happening in the model and also in our model specifically. And so the first thing that we did is we constructed different scenarios based on what could happen to the world interest rate, which enters different equations and then has endogenous effects on our model and also on the macro part of this model. And for these world interest rate scenarios, we take the dot plot of the federal interest rate. And so we have three different ones. Usually our black line is always the baseline scenario. And then we compare it to a scenario where by the end of 2030, the world interest rate is just 1% percentage point higher compared to a more optimistic one where it's a bit lower. But we have to say that the projections for this world interest rate are not immensely large. So this is why we also see the right directions of the relationships, what you would expect, but the effects are not incredibly large just because the projections for the world interest rate are not so divergent. But in general, we see that or we find it that if the world interest rate is perceived or is going to be higher, you also have this higher macro risk. For example, for sovereign risk and private sector risk is because of the higher cost of debt, of course. And all of these then has an effect on the perceived risk and again on the rationing, which we're plotting here for the different interest rate scenarios. So you see this clearly, you have a higher risk, which translates into rationing. We don't see much of an effect right now on the interest rate, which is even though the supply might be higher because of the supply might be lower because of higher rationing. It depends again also on the total excess demand, how much or how sensitive our interest rate is to this excess demand. We see an effect also there. And acknowledging this, that we do not know certain parameter values yet. What we have tried so far is like the sensitivity analysis on parameters related to this risk sensitivity. So we identified a total of 6 and run this Monte Carlo simulations. So we take 100 runs, and all together, like for each run, we draw we draw a value, we scale these parameters, and we see how it affects our model then. So the first 5 parameters are all related to our macro risk and how much they respond to what we call the main determinant. And then the last one is also related to risk sensitivity, because it's how much this relationship is between perceived risk at the financial instrument level and rationing. And okay, so a few more colorful plots we've got here. And so first we look at the macro risk, and we color it based on the individual risk parameters related to the macro risks. And what you see is the higher the sensitivity is risk sensitivity, also the more pronounced is just the response of it. So if you are in this period where you consider this macro risk high, the response would be even higher. But the opposite is true too in a period when it is lower. And all of this again has an effect on the perceived risk, rationing, and excess demand. So what you see better here a bit is that there is not only a black line, but also a red one, because what we are comparing here actually is the baseline compared to our higher interest rate scenario under these different parameter ranges. And you see there, for example, that our perceived risk are in all cases higher in the higher interest rate scenario, depending again on the parameter values. But for example, even if these lines are much higher, you can even have, if this sensitivity is really strong, really low, you can have a different sort of rationing between our basin and our, what we call this adverse scenario here, and which does have then a certain effect on excess demand and then inherently also in interest rates. And then we can also analyze what this means at the total level of realized private financing, and then more specifically on the climate finance gap and on the ambition gap. All right, so these are the sort of analysis we've done. We haven't showed you all that are in the paper, but I think for now I can conclude with, yeah. Great. Okay. Well, I leave it just right there. We have a few next steps planned ahead to use, if we get access to use the financial data that exists, to actually do what we would like to do and to validate and use it to calibrate our parameter values. Then also what will be also relevant for policy users is that we have also this risk sharing mechanisms that we can have test them, and then we also combine them. So our model with those. Thank you. Lena?
Hallo Microphone.